We are optimistic. We are staying fully invested. We're diversifying further out of tech, but we're optimistic going into next year. Obviously, there's a big decision coming out today, but I think we are going to see a rate cut. And I do think that is one of the pillars going into next year that will remain intact. Earnings and lower interest rates will be there. And so in terms of positioning, we're fully invested. Yes, having cash aside for those that need it. So having lots of conversations with clients about what's going on next year. Are you potentially retiring? Are you buying something, buying a home? Do you need cash set aside? So we're very focused on that. But for the rest of the portfolio, we're staying invested, laying off a little bit on the tech exposure that we had and going into some of those sectors that didn't perform as well this year, but staying fully invested. In addition, looking at private markets. That's another area of focus for us.
How do you try to get exposure to the private markets? Is it direct exposure? Is it through an ETF? How do you do that?
Couple of ways, but direct exposure. So we're buying into companies directly. So investments in private companies directly, but then also there's some fund of funds exposure that we have. So we think of private equity exposure in both a beta play, having broad market private equity exposure through another manager, but at the same time going directly for that alpha play and looking at some of the AI names, not necessarily the infrastructure. We did that a while back. Now it's that second layer. What else can we be invested in? So we're still believers in the AI and how it plays out, and we're looking at companies that are benefiting from it, growing their revenues and earnings there. So two ways to invest in private markets.
And how do you see the IPO market in 2026? I mean, I guess it's still going through this recovery phase, but are we going to see new opportunities with new companies coming to market?
I think so. And there's something very big playing out in the market right now. I think that's going to be something to be said for next year as well. But a big part of it has to do with interest rates, which again, I think are going to be a tailwind going into next year. But there's pent up demand. There is cash there. And we saw the mobilization of the cash that's available for the deal that's being talked about right now. So I think that continues going into next year. There's been a lot of pent up demand, and we see that play out in 2026.
How about in the fixed income space? It's been a good year for fixed income, kind of high single digit total returns. How do you think about allocations there?
Yeah, so in terms of fixed income, we do a couple of different things. Not only our core fixed income allocation, the more traditional fixed income rates are still pretty good, even if they are lower, certainly above where they were a few years ago. So we like core fixed income, but what we like even more, we are looking at private credit. So private credit and some floating rate, and then another substitute for fixed income that we like to use, and going into I think, higher volatility year and is structured notes. So part of our allocation, it's not just the traditional core fixed income, but supplementing with floating rate private credit, which I think for select managers is going to play out very well. And then also with some of the structured notes that give you more income and a targeted income, especially in a more volatile year, which I think we can have even if we are optimistic.
Sevasti, a moment ago you spoke about people looking to retire and how you are advising them. There was an article in the Journal, I think it was this week, the Wall Street Journal, talking about how a lot of folks with money in 401ks are mini millionaires now. I mean, they're looking at their returns and going, wow, my money did all that. Is it still true that folks closer to retirement should be moving that money into fixed income?
So we take a close look at that. That's a great question. It depends on how much, not all of it. What we like to do is, so we still are more optimistic about equity markets versus fixed income. Yes, there's going to be volatility, but how do you get away from that? So we like to look at and be very clear on cash flows. So in the next year or 18 months, how much cash do you need? Let's put that aside. I don't think the traditional 60-40 or taking your age and subtracting something and just putting that whole amount into fixed income, I don't think that works. I still do think if you have diversified exposure, and by that I mean not only by sector, by security, but public and private, because we do know about the concentration in the public markets. So if you have that diversified exposure and you have 18 months worth of cash aside going into retirement, the reality is people are retiring a little bit earlier, but living longer. So we have 30, 40 years that we need portfolios to last. So I don't want to go to fixed income too quickly.